For many years, China has played a huge role in the global financial system by owning a large amount of U.S. government debt. In fact, at one point, China was the biggest foreign holder of U.S. debt, even more than America's closest allies.
Most powerful weapon in China's arsenal, selling US treasuries.
This meant that China had a lot of influence in the U.S. financial system. Now, let's look at a chart that shows the biggest foreign holders of U.S. Treasury securities in early 2024. As you can see, Japan is now the top holder, owning more than $1.1 trillion in U.S. debt. But this wasn't always the case. If we look at data from 2018, China was actually the largest holder back then. Since that time, China has been reducing the amount of U.S. debt it owns. If this trend continues, China may one day hold very little U.S. debt compared to other major economies. This raises an important question as to what would happen if China stopped buying the United States debt altogether. For those who don't understand, the U.S. Treasury bond has a long history that goes back to the early days of the country. It all started during the American Revolution, 1775 to 1783, when the U.S. government needed money to fight the war against Britain. Since the government didn't have enough cash, it decided to borrow money from the public by selling bonds, paper money in the form of bills of credit. This bond is simply a promise that the government will pay back the money with interest after a certain period. Most of the Treasury securities the government still offers today, such as bills, notes, and Treasury bonds, were created in the 1920s. The money raised by selling these securities helped pay for the country's part in World War I. United States savings bonds were first sold in 1935 and helped to cover the cost of programs aiding people during the Great Depression. After the U.S. won its independence, the government continued using bonds to raise money for different needs, like building roads, railways, and later funding wars such as the Civil War, 1861 to 1865, and World War I and II. During these wars, the government encouraged citizens to buy bonds as a way to support the country. Over time, the U.S. Treasury bond became one of the safest investments in the world because the U.S. government has never failed to pay back its debts. So if China stopped buying U.S. debt or even decided to sell off all the U.S. treasuries it owns, would this cause a financial crisis that shakes the entire world economy? Or would other investors quickly step in to take China's place? To complement the understanding, let's continue to break down what the system of the U.S. government debt actually is and why so many investors and countries, including China, buy it in the first place. The U.S. government debt is the money the United States government borrows to fund its spending. They achieve this simply by selling securities to investors. These securities are issued by the U.S. Department of the Treasury and come in three main forms: Treasury bills, T-bills, which are short-term securities that mature in less than a year, Treasury notes, T-notes, which are medium-term securities that mature in 2 to 10 years, and Treasury bonds, T-bonds, which are long-term securities that mature in 20 to 30 years. Together, these are commonly called treasuries, and they are one of the most popular investments worldwide. The reason they are so widely bought is that they are backed by the U.S. government, meaning the risk of default is extremely low. Investors, including foreign countries, pension funds, banks, and everyday Americans, buy these treasuries as a way to protect their money while earning some interest. Now let's look at how much the U.S. actually owes. According to the latest data from the U.S. Department of the Treasury, as of March 12, 2025 that this research is made, the total U.S. federal debt has skyrocketed to $36.22 trillion. That's an enormous amount of money, and foreign investors, including China, own a part of it. And again, from the U.S. Department of Treasury, as of December 2024, China holds around $759 billion in the U.S. treasuries, making it one of the largest foreign creditors to the U.S. But China isn't the only country that owns U.S. debt. Other major holders include Japan, European countries, pension funds, central banks, and even private American investors. So, why do investors, especially countries like China, buy U.S. treasuries in the first place? There are a few key reasons. First, U.S. treasuries are considered one of the safest investments in the world because the U.S. government has never defaulted on its debt. Countries and large institutions trust that their money is secure. Secondly, the U.S. Treasury market is massive, meaning that investors can easily buy and sell these securities at any time. This makes Treasuries a flexible and attractive investment. If China decided to sell all its U.S. Treasuries overnight, would it send shockwaves through the global economy? In theory, selling such a large amount of debt could drive the U.S. interest rates higher, make borrowing more expensive for the government, and weaken the U.S. dollar. However, because the Treasury market is so large and active, there would likely be other buyers ready to step in and purchase those bonds, preventing a total collapse. So while China's decision to stop buying or selling U.S. debt could have significant short-term effects, the long-term impact might not be as dramatic as some fear. The question is, what would China gain or lose by making such a move? One of the most important things to understand is that the US dollar is the world's main reserve currency. This means that central banks in many countries keep a large portion of their money in US dollar assets. These assets include US Treasury bonds, which are like loans the US government takes from investors. China is one of the biggest holders of these bonds, but why? To understand this, we need to go back to the early 2000s, when China's economy was growing at an incredible rate. Many foreign companies and investors were rushing to China to open factories and build businesses. From American companies to European corporations to East Asian manufacturers, everyone wanted a piece of China's economic boom. This rapid industrialization made China a global manufacturing powerhouse. Since China was producing and selling so many goods to other countries, it started earning a massive amount of foreign currency, especially US dollars. This happens because international trade is usually conducted in US dollars. When China sells products to other countries, it receives payments in dollars. Over time, because China exported more goods than it imported, it built up a huge trade surplus, meaning it earned more than it spent. If you look at China's total foreign reserves, you'll see a massive increase. The World Bank's data shows that China's reserves grew rapidly, reflecting the fact that it was selling more goods than it was buying. Now, what does a country like China do when it has trillions of dollars in reserves? Simply keeping the money in a bank wouldn't be a good idea because it wouldn't earn any returns. So China had to find a safe and reliable way to invest this money. One of the best options available? U.S. Treasury bonds. Treasury bonds are considered one of the safest investments in the world because they are backed by the U.S. government. This means that China can park its money in U.S. Treasuries without worrying about losing value. Over time, China's purchases of U.S. Treasuries increased dramatically, making it one of the largest foreign holders of U.S. debt. Between 2000 and 2008, China steadily increased its ownership of U.S. government debt. If you look at a graph of foreign holders of U.S. Treasuries, you'll see that China's stake grew year after year. This was a direct result of its huge trade surplus and its strategy to invest reserves in safe assets. China's decision to buy U.S. debt wasn't random. It was a logical financial move that allowed the country to protect and grow its wealth while maintaining a strong economic relationship with the U.S. For many years, Japan was the largest foreign owner of the U.S. Treasury bonds. This made sense because Japan was a major economic power in Asia, and it had a large trade surplus with the United States. Japan, just like China, needed to invest that surplus money somewhere, and U.S. Treasury bonds were a safe and reliable choice. In fact, in the year 2000, Japan owned over $307 billion worth of U.S. Treasuries, while China only owned about $70 billion. But as the economies of Japan and China changed, China's role as the world's economic powerhouse grew stronger, and China eventually surpassed Japan in the amount of U.S. Treasuries it owned. It is evident that China's holdings of the U.S. Treasury bonds jumped from $70 billion in 2000 to more than $700 billion by 2008. During the same period, Japan's U.S. Treasury holdings also grew from around $300 billion to over $600 billion. By 2013, China's holdings reached a peak of more than $1.3 trillion, which was huge. But since then, China's holdings have started to go down. From November 2024, China's holdings of the U.S. Treasury bonds had dropped to just $760 billion. So, why is China selling off its U.S. Treasuries? And what does this mean for the United States? There are many reasons for this decline, but one of the biggest factors is China's investment in its Belt and Road Initiative. BRI. The BRI is an enormous global infrastructure project that China launched to connect Asia, Europe, Africa, and other parts of the world. This project aims to build a network of roads, railways, ports, and pipelines, and it's one of the most ambitious economic development plans ever made. To fund this huge initiative, China has been using a lot of its money, including money that might have otherwise gone into buying U.S. Treasury bonds. So when China shifts its focus to investing in the Belt and Road Initiative, it leads to less money available for buying U.S. Treasuries. This change is significant because it could affect the U.S. economy in various ways, such as impacting interest rates, the strength of the dollar, and the overall financial stability of the United States. Understanding why China is making these moves is important to see how it could shape the future of global finance. The BRI is a massive global infrastructure project aimed at improving trade routes and building stronger economic ties with other countries. If we look at this graph of China's annual investment into the BRI from 2013 to 2023, we can see that China has been consistently investing huge amounts each year. In 2018, the investment peaked at over $50 billion, a significant sum. To finance these large infrastructure projects and achieve its ambitious goals, China often turns to its foreign reserves for funding. In addition to the BRI, China is also part of a group called BRICS, which stands for Brazil, Russia, India, China, and South Africa. BRICS is an alliance of emerging economies that work together to promote political, economic, and social cooperation. The purpose of BRICS is to offer an alternative to the financial systems dominated by Western countries, such as the International Monetary Fund, IMF, and the World Bank. As part of this group, China has been helping to reduce the reliance of BRICS countries on U.S. Treasury bonds. By cutting back on U.S. debt, BRICS nations aim to diversify their financial reserves, encourage the use of local currencies, and create financial systems that are less dependent on Western institutions. China has been increasing its gold reserves. Over the same years that China reduced its holdings of U.S. Treasury bonds, it has been steadily accumulating more gold. This move helps China strengthen its financial position and reduce its dependence on the U.S. dollar. This shift is happening for two main reasons. China needs to diversify its investments and also wants to strengthen its economic independence. By moving away from buying U.S. treasuries and focusing more on gold, China is trying to protect itself from any financial problems caused by outside forces, such as political tensions and sanctions. But what could happen if China decides to stop buying U.S. debt or even sells some of its existing U.S. treasury holdings? The U.S. could face several challenges, though how bad these problems are would depend on a lot of other factors, like how other investors react. One of the most obvious impacts would be on U.S. Treasury yields. Treasury bonds are like loans the U.S. government takes from investors, and in the bond market, prices go down when yields go up. If China, one of the biggest buyers, reduces its purchases, it could lower demand for U.S. treasuries, which would cause their prices to fall. When prices fall, yields rise. This means that the U.S. government would have to pay higher interest rates to borrow money, making it more expensive for the country to fund its spending. Another possible effect could be on the value of the U.S. dollar. If China sells off a large amount of U.S. treasuries and reduces its holdings of U.S. dollars, the dollar could lose value. A weaker dollar could have mixed results. On the one hand, it would make U.S. products cheaper and more attractive to buyers in other countries, so American exports might increase. But on the other hand, a weaker dollar would also make imports more expensive, meaning the cost of goods like electronics, cars, and even food could go up for people in the U.S. If China really starts selling off a lot of U.S. treasuries, it could also make investors around the world nervous. Treasuries are known for being one of the safest investments, so if people start to lose confidence in them, it could cause problems in financial markets worldwide. This could create uncertainty and volatility, which would affect not only the U.S. economy, but also the global economy. That said, it's important to remember that the U.S. Treasury market is huge, with daily trading volumes often reaching more than $500 billion. Even though a big change from China would certainly make headlines, the depth of the market might be able to handle some of the impact. If other investors find treasuries attractive, they could step in and help absorb some of the effects. So, why does the question, what happens if China pulls out of the U.S. debt? Well, China has invested a lot in the U.S. treasuries. This has helped the US finance its national debts and has given China a stable way to store its surplus dollars. However, China's move away from treasuries shows that the future is changing. Things are shifting, and it's important to pay attention to what could happen next. If you enjoy the video, kindly like and subscribe for more quality videos like this, and I would also love to read your opinion in the comments. Thank you for watching.